Hello everybody and welcome to this new video about Sea Limited, and it's not very good. It's not very good, and I had a feeling that this would be bad because of the gaming division, but it's actually a little worse than that. And you may remember in my Friday videos, I often tell you that I don't focus much on Sea Limited because of the overhang for that gaming division. But wait until the end of the video, because I've made a decision on this stock, and to me, this stock has a bunch of problems, and the big problem, in my view, is that it is catering to Wall Street, and Wall Street is not catering to it, and it's been an issue with this business. But let me get started. So, first of all, as expected, the gaming division, and I'll start with this because that's the red flag of this company. It's slowly disappearing. Free Fire, their major game, has been banned in India. And they don't have a lot of games that are that popular, and so that division, I mean, not as popular as Free Fire, right? And so that division is slowly disappearing. We've seen this for the past 4 or 5 quarters, and it keeps disappearing. And so my guess is that because of that division disappearing, keep in mind they still have 529 million of revenue this quarter from that division. I mean, this is going to create an overhang on the overall revenue growth, in my view, for 2 years until it nearly disappears or completely disappears, or I don't know. Will they get to 100 or 150 million, the gaming division? To me, that's the same as completely disappearing, right? But that's going to be an overhang on the stock as far as total revenue growth, and that keeps going, and they're not improving the gaming division at all. But the plan of this company was to take the profits of the gaming division and invest those profits to grow the e-commerce division and the fintech division. That was always the thesis of this company. This is disappearing, and you're going to take that cash and invest it to grow the rest. But this is what really annoys me. Actually. So when I look at their report, I see this and I'm like, there's $510 million of adjusted EBITDA, right? Proxy for cash flow. Why? Why do we have 510 million of adjusted EBITDA? That doesn't make any sense. Or is it just because we're trying to cater to Wall Street and Wall Street wants profits, and these stocks were associated with Cathie Wood and they were like, oh, profitless tech is worthless. And so they changed their entire business strategy. Now they're not a profitless tech anymore, and Wall Street rewards them with a minus 28%. So let me ask this another way: Did the Sea Limited value proposition change? Did the investor base change? Do we have an investor base composed of value investors now? Are we going to get a dividend? Maybe we're going to get a dividend soon, because this is getting ridiculous. And look at the delta compared to a year ago. They're showing this as a point of pride, but this is not a point of pride. This is a company that has stopped investing in itself. Right? They're not investing in themselves anymore because the delta is $1 billion. So they have $1 billion more compared to Q2 of 2022 and Q2 of 2023. So the delta for a quarter, in one quarter, they have $1 billion extra compared to what they used to have, because back then they were investing in their growth. Right? They were look at the way it used to be, right? So they were making money with the gaming division, right? And that money was compensated with negative cash flows from all of the other divisions. And now they're getting profits. They're making money from all of the divisions. So what happened to taking the money from gaming and investing it into the rest of the business? That has entirely gone. Now they take the money from gaming, and they also take money from the fintech and from the e-commerce division, and they're just not doing anything with that money. They're not investing in their growth. They're not believing in their growth. And this is shocking to me, because they did not need to do that. They didn't need to do that. This is a company that recently went public, and thus they have a lot of cash, right? $7.7 billion of cash is parked. It's just parked there, sitting pretty. What are we doing with this cash? That doesn't make any sense. I would have been fine with this company, kept the negative EBITDA, right? Keep negative EBITDA for 4 quarters, 5 quarters, invest heavily in your growth. Do the J curve. I don't have a picture of the J curve here, but that's like a typical J curve. Yes, invest in your growth, and then you focus on the positive cash flows and adjusted EBITDA. But this makes no sense. This is coming as a bunch of cash, and they're not investing in their growth. And here's another problem, and this is because they're not investing in their growth. If you actually look at the numbers, so the narrative used to be this, and this is still the narrative that they're showing, is like, look, our marketplace revenue is growing at 28%. That's great. Not quite my 30% threshold, but I'm a growth snob, so I guess I understand 28% is good enough. So that's what they're showing. But notice how in the report they're conveniently leaving out Q1 2023, right? You have to go back to Q2 2022 to get that 28%. Now, what I like to do on this channel is I like to download myself what they reported for Q1 2023, and of course what they just reported in Q2 2023, and I just did that. So this is from 3 months ago. 3 months ago, they told us this breakdown for the revenue, and this is today's breakdown. And so let's calculate the gaming division. The marketplace, the e-commerce division. So what are we showing for e-commerce? We're showing in Q2 2,111, and we're showing in Q1 2,067. And I get there's some seasonality, but that's not my point. My point here is that I like to annualize the rate and see what it looks like. So forgetting about seasonality quarter to quarter, we see we're getting 2.1% from Q1 to Q2. And keep in mind, you may say, oh, there's a slump between Q1 and Q2. Well, that's not true. If you look at what's happened to Mercado Libre has stellar growth between Q1 and Q2. So I think this is more than fair than to just look it's more than fair to just look at the increase from Q1 to Q2. Maybe a little less fair from Q4 to Q1 because Q4 at end of year sales. But from Q1 to Q2 is more than fair. It's only growing at 2.1% quarter over quarter. 2.1%. If you annualize that, that's 8.7%. Right, 8.7% is the snapshot rate of growth right now. If you take a picture quarter over quarter, that is not good at all. That is not good at all, and that is not 28%. And I don't like that they conveniently left out quarter after quarter after quarter in Q2 because many people don't go through the hassle of going back into Q1 and doing that comparison. To me, the revenue growth in the commerce division is markedly slowing down. And if you look at the digital financial services division, see, that's how you know. They don't have any problem showing you everything here. So they show you everything. They show you Q1 and Q2 for the digital financial services. And why do they do that? Because it looks better, right? It's 53% year-over-year growth. And actually, it only looks slightly better because that's 3.6% quarter over quarter between Q1 and Q2 here of 2023. And annualized, that's 15%, which is better. But it's nowhere near my usual threshold of 30%. And if you add to that the fact that we know that the gaming division is slowly going away, and we'll see what's left of it 2 years from now, probably not that much. We don't get a pretty picture. We even get a picture where revenue may go down quarter over quarter at some point, and I do not like seeing that. And of course, there's a reason why it's going down like that. That's the reason. What's the reason is this cost on expenses. Look at this. I mean, first of all, I think it's very telling that they're like, oh, it's a marketing expense. Oh, it's an R&D expense, right? It's not, it's how accountants call it. That's fine. But, to me, marketing is an investment. To me, R&D is an investment, not an expense. This is the problem, right? So we're saving roughly $500 million. Roughly $500 million on marketing that we saved compared to last year. Right, and we're saving roughly a casual $100 million on R&D, right? So why? Why are we doing that? Why are we saving $600 million that we could have spent to grow the business? In one quarter, we're saving, I mean, why? Why are we saving this money? Right? That doesn't make any sense to me. They should invest in their growth. They should fight for future growth. They should invest in their growth, especially in Indonesia, where they have Lazada coming. Lazada, backed by Alibaba, who is a fierce competitor from what I'm reading. No, we're saving on marketing and we're saving on R&D, and we have $7.7 billion in cash literally melting to inflation. That's what they have on balance sheet. I do not understand this. Oh, and by the way, to make matters worse, we're showing great earnings now, great net income. And of course, if you analyze that, that will be a few $100 million of taxes each year. And we can pay it, right? We have $7 billion of cash on balance sheet. We can pay taxes, right? We don't need to invest anywhere else. In conclusion, this is a stock that has catered to Wall Street, except Wall Street's demands, requests vary from season to season. You know, that's the Ben Graham quote. Wall Street is manic depressive. Mr. Market is manic depressive. So that's what it was requesting back at the end of 2021, early 2022. The market was like, oh, profitless tech is bad. We need to have tech that has profits. Now they show profits. And they stopped doing everything that they were doing right, i.e. investing in their future. Now they show profits, and this is how Wall Street rewards them. A minus 50% back to the October lows, but of course a business that is much worse than in October, in my view, because, they're making EBITDA, but I don't care about EBITDA. I want growth. I invest in product adoption. I invest in the future leaders, right? Anyways, I'm not a value investor. I don't want a dividend check. So, anyways, I do not know why they caved, and I do not know why they did not do what they said we were going to do, which is take profits from gaming and invest it in e-commerce. No, that's not what they've done. And in conclusion, what am I gonna do? What am I gonna do with this stock, right? So I'm down big on the stock. Right, more than 50% down, and that's bad, right? But I actually intend to sell it, take my loss. That's what I intend to do, because and I won't do this right away, because the 28% drop today is likely an overreaction, like it always is. This is what we call the post-earnings drift. These drifts last, 4 weeks, 6 weeks, and then the stock goes back into a range. So, of course, I don't do any overreaction. Don't sell right away. Wait for the post-earnings drift to be fully gone. But then I'll typically, I will harvest my losses on this stock and create some losses to offset potential gains in the future, and move to a faster horse. And there are many companies that are still growing extremely fast, that are down as much as Sea Limited, if not more than Sea Limited. It makes sense to swap in this situation. The CEO tells us they want to reinvest in growth now, but I'm afraid that's a little late, and who knows, if they reinvest in growth now and growth picks back up, maybe Wall Street has issues again 2 years or 3 years from now and starts pressuring from something else, and then the CEO caters to Wall Street and does not cater to the business itself. To me, this was a wonderful business. They should have kept investing in their growth. They had plenty of money from going public. Why didn't they invest that money in the growth? Why weren't they all over through marketing channels, through R&D? Right? You have to push service and product adoption with marketing. Marketing is an investment. And they didn't do it. They didn't invest. So I'm sad about it, but that's okay. Like I often say on the channel, if I'm right on 6 stocks out of 10, that will make a very handsome portfolio that will beat the market. And so this is one that is very likely a sell. That is a sell for me. So this was not investment advice. This was just entertainment. Please don't dislike the video too much if I criticized your favorite stock. It's okay to disagree. I may be entirely wrong, right? the CEO may invest everything in marketing and maybe it will boom again. But that's not how I'm feeling right now. Appreciate your subscriptions if you can. It helps the channel. Thank you and have a wonderful day.